Much of the US is sweltering at this time of year, and the central bank is dunking the economy under the equivalent of a very cold shower.
Today, the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
At between 2.25 and 2.5%, the Federal Reserve has brought its main benchmark lending rate up to what's considered a neutral range that, in theory, neither stimulates nor hinders economic activity. That kind of thinking is being put to the test in the most pressured of climates, having slashed its benchmark interest rate to near zero to save the US economy from COVID. The Fed's change of course is as dramatic as the deteriorating economic outlook. In just a matter of months, it's imposed the steepest rate hikes since the early 1990s, all to try to tame the highest inflation since the early 1980s. US mortgage rates have accordingly nearly doubled, freezing the real estate markets in some parts of the country. So will the Fed's aggressive new position tip the economy into a recession? That question will be answered for some on Thursday if new figures from the Department of Commerce show the US economy contracted in the first 6 months of the year. But the Biden administration isn't waiting for those numbers to argue there's no recession, claiming other metrics such as low unemployment and sustained spending are signs of a healthy economy.
The totality of the economic data is consistent with that type of transition and is not consistent with a recession.
As the US teeters on a second recession in as many years, another consumer sentiment poll, this time from the Conference Board, has fallen for a third straight month. Owen, Fairclough, CGTN, Washington.